Most people aren't aware that waiting until 65 to retire can actually cost them more than retiring early. And I'm going to explain why this is the case and why it could be a huge mistake that many of us might come to regret later in life. So we need to understand that there's a hidden danger of waiting to retire, and that's because of this one concept that is very easy to confuse. And the concept is understanding the difference between life expectancy and health expectancy. Now, life expectancy is the total number of years a person is expected to live, whereas health expectancy measures the years lived in good health, which means you're free from chronic illness and disabilities. And according to the data on a healthy life expectancy, the average person can only expect to live around 65 to 70 years in full health. And if we look at this map right here, at least for many of you that are watching that are likely in the United States, that means that on average, you're likely to have about 66.1 years of good health. Of course, that's the average, and that's not all of you. But my interpretation of looking at something like this and why many of you watching might be considering an early retirement is because you understand that waiting until 65 to retire will obviously mean your nest egg will continue to grow, which can feel great, but you might be unknowingly making a costly trade-off with all the time you're giving up. And it's interesting because the reality of this is that people are not really retiring early. In fact, only about 32% of people are retiring between the ages of 60 to 64. And as of recent, only about 11% of people are retiring between the ages of 55 and 59. Now, what most people are doing is actually waiting till 65. About 80% or more people are doing this. So with the average health expectancy being 66.1, most people that end up retiring in this age group may already be facing health challenges that really limit the ability to travel, pursue hobbies, or fully enjoy their retirement. This is why it's so important to take care of your health now. Now, this obviously isn't me telling you, hey, you should just go pull the plug. My job as an advisor is really to let you know the earliest you can possibly make that decision so that you enjoy these years while you're still in good health and also maintain financial security. Of course, my point is that the real danger of waiting too long to retire is that while your nest egg grows, you could be trading away the best years of your health and missing out on the freedom and lifestyle that you've probably worked really, really hard for. So for those of you that understand this concept, say, hey, I get it. Now, what do I actually do about this? This is where actually sitting down, creating a financial plan for yourself, running the numbers, and getting a clear picture of where you stand today and where you want to go can be critical, especially at this point in your life. For a lot of people that reach out, they might have already worked with an advisor. And sometimes they say, hey, why didn't my advisor tell me I could retire earlier? They just kind of told me to work to 65 because, Medicare, and that's a good rule of thumb. But what they did, they stack up a document on their desk and say, hey, don't change anything. To me, I think that's a big risk. If delaying retirement, even though you're in a financial position to do so and you want to finish strong, that might mean that you're not going to spend enough time with family. You might not have enough time to prioritize your health. And if you're in the fine spot to retire early, some people say, why wouldn't I? I just want my clients to know, again, the earliest time they could retire. So here are a few factors that I believe can put you in a better position to retire before 65. Now, there's a lot of things that can go into something like this, but I think these are three that really can help move the needle. Number one is just being flexible. See, the classic technique to know, hey, how much can I spend is using a withdrawal rate. Now, in other words, based on your asset allocation, historical return data, in theory, you should be able to calculate a safe annual portfolio withdrawal rate. Typically, people will come to the conclusion 4%, but this approach does not account for investment returns that you're actually going to experiment in retirement. For example, what's considered a safe withdrawal rate can change during different periods of your retirement. And if we look at this chart, historically safe withdrawal rates rarely fall below 5%. In fact, they only really fell below 5% during the late 60s, which is probably the worst possible environment to retire in. You can see that on this chart that at least historically, it means that you could increase your withdrawal rate during different periods of your retirement, especially if you experience strong investment returns in the first few years of your retirement. And for those that are really nearing those final years before you retire, we use a new method called the risk-based guardrails approach, and it takes into consideration changing market returns, changing inflation, future income sources, your life expectancy. A lot of different things can go into this, and I've found it to be one of the most comprehensive tools that really I've seen out there for advisors. And the reason why I believe something like this can help you retire early is because it's evaluated every single month to really ensure you're on track as your portfolio changes, as of course your life changes, your income sources change. And you can see here, for example, when the risk in your plan decreases, potentially because of market returns being better than expected, it can provide you a measure of how much you can safely increase your income by. So how it works is if my clients have accounts that have performed well and the risk within their plan has decreased, what it will do will give them an opportunity to increase income on a monthly basis if they want to. Now, many of them, maybe they don't want to because they don't need it, but it's this increase of spending when prudent that helps you prevent the risk of ending retirement with millions and millions of dollars that were unspent, which many people don't really talk about when it comes to planning. But on the flip side, when the risk of your plan is increased, it provides you with a good measure of how much you should decrease your income by so that you reduce the chances of running out of money, especially if you're somebody that wants to retire early. So really why this one can really move the needle, whether your advisor has the tools to help you implement this or not, is just the ability to stay flexible with your spending, adjusting as your portfolio and circumstances change so you can enjoy your retirement without the fear of sequence of return risk or running out of money when the market goes down, and also not delay your retirement and miss out on some of the best years of your life. Okay, so the second thing that could put you in a better position to retire is understanding how spending actually works in retirement. I think another reason why people continue to delay retirement is they see these linear projections, think inflation is never going to stop, my spending is going to continue to go up as long as I age, but that's not necessarily real life. That is just a spreadsheet. Now, the research shows that there's actually about 3 different stages of retirement. There's the go-go years, the slow-go years, and the no-go years. Now, when you first retire, you probably have quite a bit of energy, you have health, you can travel, you can finally start to do things you've been putting off. These are the go-go years. So very often when we first start with someone that retires early, we expect their spending to be higher in the earlier stages of retirement because it's the time where they're healthiest and they can actually enjoy it. But towards the middle of retirement, most folks start to slow down. Things just don't work the same like they used to anymore, and you start to actually lose a little bit of your energy, right? So typically spending starts to slow down. And the last stage of retirement are the no-go years. You arguably have the least amount of energy in this stage, although I know some 95-year-olds that are really, really high energy, but they're the outliers. And that's because you often have expenses arising, such as increased medical costs, and it's going to start to ramp up. So this is more close to reality of what spending looks like. Most people, inflation adjusting spending is, again, highest at the beginning, decreases over time, and it starts to kind of ramp up a little bit later in life. And by properly accounting for something like this, it allows you to have more income in those early years when you want it without sacrificing the income you will likely need towards the end of life. And finally, the third thing that I think is going to help move the needle and as far as putting you in a better position is how you invest your retirement nest egg. Oftentimes people think you need to get really conservative and just own cash and bonds when you retire, maybe a little bit of stocks, but the reality is that you have to make this money last for the next 30 to 40 plus years. So about a year ago, I was talking to someone who was evaluating our firm, and they were convinced that T-bills were really the only retirement strategy they felt like they needed that time. I mean, it's a guaranteed 5% yield, and it's backed by the full faith and credit of the United States government. And they just felt like the stock market was a little too risky for them. They said they can always get back in when the market is safer, but they thought there was going to be a correction coming pretty soon, so they wanted to stay in T-bills. But of course, in hindsight, if we look back, the S&P 500 hit about 40 new all-time highs over that period, returning just over 35%. And the whole way up, people have been trying to tell us that the world is about to end. Now, the market obviously will have a correction eventually. That's what markets do. It's a feature, not a bug, and it's sort of the price of admission. But if we look at this chart from the blog, it's called The Wealth of Common Sense. Over the long run, the difference between average return of stocks, bonds, and cash over the past 95 years paints a picture as to why we want to own stocks over the long run. The average return of that period of stocks is around 9.8%, bonds 4.6%, and then cash around 3.3%, right? That means that T-bills barely kept up with inflation over the long run. This is why it can be dangerous to over-leverage yourself and try to time the market. In fact, researchers find that asset allocation and overall portfolio structure was responsible for over 90% of the variation in a portfolio's quarterly returns. Now, that's not stock picking or timing or taxes, but asset allocation. A lot of people that come to me, they say, hey, Matt, I want to retire at 55, I want to retire at 60. And I look at their portfolio and I see, we need to start making adjustments in order to structure it in a way that your money can keep up with inflation, but also so that you have enough the exact amount that you need in reserves to weather those inevitable market corrections. Now, no one knows the exact returns and what that might be like over the next 95 days, let alone 95 years, but there are a lot of variables we simply just cannot predict. But this is why you diversify, and this is why asset allocation is so important, why you own multiple different asset classes. So when the stock market is down 30 to 40%, you know where you can go to create a monthly paycheck and not run out of money. The math really starts to change, where again, it's not about just investment returns, it's about tax savings returns and the tax efficient placement of assets in the right accounts for retirement. So we just went through why I think waiting to retire at 65 can be a huge mistake for many people, especially if you're in a financial position to do so. We talked about how important your health expectancy is and how you want to factor that into your decision. And then we talked about why you need to put a plan together that accounts for flexible spending, the retirement smile, and longevity, and one that really moves the needle, which is the asset allocation. But if you do plan to retire at 60 or before 60, there are a few lessons that I learned from my clients that I want you to know about so that you are prepared to retire early without having any regrets. So you should definitely check out the video by clicking right here. Once again, this is Matt calling you. If you're ready to retire and you want someone that is dedicated to making sure you've checked all the boxes and you want someone to help you along the way, we have a process that we use to help you evaluate our firm. You can click the link in the description and we'd be happy to talk with you.